ETFs. That word is everywhere right now. Simple investing, low cost, market like returns. Most conversations somehow come back to ETFs. But when it's actually time to invest, the real confusion starts there. What exactly is an ETF and how do you choose one? Hi everyone, welcome back to Learn Investment with me. In this series, we have already covered demat accounts and bonds and also dividends. Today, we are focusing on ETFs because once people understand them, ETFs often become a very practical tool for long term investing. In this video, I'm going to explain ETFs in a simple, real life way. By the end, you'll understand what an ETF is, how it works, the major types of ETFs, including dividend ETFs. So, what exactly is an ETF? ETF stands for Exchange Traded Fund. The easiest way to think about it is the ETF is a fund, meaning it holds a basket of investments, stocks, bonds, golds, sometimes even international assets. But you buy and sell it on this stock exchange like a share. The exchange traded part matters because it means you can trade it during market hours and the prices moves throughout the day. Now, why do so many people like ETF? Because ETFs can give you diversification in one purchase. Instead of choosing individual stocks one by one, you can buy an ETF and get exposure to the whole group of companies or a bond portfolio or gold, depending on the ETF you choose. Most ETFs work by tracking something, usually an index. So, for example, an ETF that tracks a broad market index is designed to mirror that index. When an index goes up, the ETF generally goes up. When the index falls, the ETF generally falls. One of the biggest advantage of this approach is that it reduces the pressure of pick the perfect stock. Instead, you are participating in the market over time, which can be a cleaner strategy for long-term investing. Now, here's an important part. ETF is a format, not a single asset. What's inside the ETF determines your risk and return. So let's talk about the main ETF types because ETFs are just not only about the stock. The most common category is equity ETFs, which invest in stocks. Within equity ETFs, you'll find broad index ETFs that represents the overall market. These often become single long-term building blocks. Then there are sector or thematic ETFs like banking, IT, pharma, and so on. They can do very well in certain phases, but then one can also fall sharply because they are concentrated in one part of the market. Now, within equity ETFs, there's another category where many people specifically look for that. That's called dividend ETFs. Dividend ETFs are designed to focus on companies that pay dividends more consistently or have relatively higher dividend yields, depending on the ETF strategy. So, the appeal here is that you are not only looking at the price growth, you're also paying attention to potential cash flows. But a quick reality check here I would like to give is dividend focus does not mean guaranteed income. Dividends are decided by companies. They can increase, stay the same, or even reduce depending on business performance and policies. We have talked a lot about dividends in the previous episode of the series. If you want to know in detail, go check that episode out. And this is where a lot of confusion happens. When you buy a dividend stock, you are directly owning that company and you receive dividends from that company. When you buy a dividend ETF, you are buying a basket of dividends paying companies. So your dividend experience comes from the overall basket, not one single company. Also, depending on the ETF structure, dividends may be distributed to you or reinvested in the fund. So, if dividends are a key reason you are considering the dividend ETF, it is important to check how that ETF handles distributions. Okay, moving on. Next category is debt ETFs, also called bond ETFs. These invest in bonds, government bonds or corporate bonds, depending on the ETF. Debt ETFs are usually used when the goal is stability and lower volatility compared to the equity. We have talked about bonds in the previous episodes of the series. If you want to learn more about it, go check those episodes out. Now, then there are gold ETFs and sometimes silver ETFs. They track commodity prices and are commonly used for diversification without holding physical gold. And you'll also find some international ETFs, which provide global exposure depending on what's available through the listings and platforms. So, in one sentence, ETFs can invest in stocks, bonds, golds, or global markets. The ETF is simply the wrapper. Now, a common question is how many ETFs are out there? The number is large and it keeps growing. So the real skill is not finding an ETF. It's filtering and choosing what fits your goal. To do that, you only need a few key terms, nothing overwhelming. First is NAV, net asset value, basically the value of the underlying assets per unit. Second is the market price. What is a market price? It's the live trading price is you see on the exchange. In liquid ETFs, the market price stays close to the NAV. In less liquid ETFs, the gap can be wider. Next is the expense ratio, the annual fee. And this is one of the very important part which you need to look at when filtering out an ETF. Index ETFs often have low expense ratios. Over long period, costs matter. Next is tracking difference or tracking error. If an ETF is trying to match an index, you want to match closely. Lower tracking difference is generally better. And then there's liquidity and the bid ask spread. Liquidity means how easily you can buy and sell the ETF. Bid ask spread is the small gap between the buying and the selling price. Smaller is usually better. If you want one simple filter, a strong ETF usually tracks a clear index, has a reasonable cost, that is your TER expense ratio, and has a decent liquidity. Now, the practical question comes up is where does it make sense to start? If you want a straightforward approach, a broad market index ETF is often the safest place to start because you're not betting on one single company or one sector. You're buying the market, you're participating in market's growth. It's not flashy. You might feel it's boring, but let me assure you that boring often works in investing because it's easiest to stay consistent that way. Once you're comfortable, you can explore other categories based on your goals. Debt ETFs for stability, gold ETFs for diversification, dividend ETFs if you want an income focused tilt, and sector ETFs if you understand the risk and the cycles. Now, where do you research ETFs and where do you buy them? Because ETFs trade on the exchange, you typically need a demat and a trading account, the same setup used for the stocks. We've also talked about demat accounts in the previous episodes of the series. If you want to learn more about it, go check that series episode out. For research, exchange websites like NSE and BSE shows listings and the live prices. Fund houses ETF pages are useful for holdings, expense ratios, and index details. And broker apps or finance websites make comparison easier. Volume, liquidity, and basic data in one single place. To buy ETFs, you use your broker app. Most major brokers allow ETF trading. Now, let's talk about the honest pros and cons of investing in an ETF. On the positive side, if we talk, ETFs offer diversification in one product. You don't have to go and buy different stocks and exchange in different funds to get their diversification. They are often low cost, especially index ETFs, because they are not being managed actively. There are some actively managed index ETFs as well, whose TER is more, but most of the ETFs are passively managed. They have a lower expense ratio. They are transparent, you know what they track. Okay. And they are convenient to buy and sell during market hours, unlike mutual funds. On the downside, ETFs still carry market risk. If the market falls, an ETF falls. There can be a tracking difference. Some ETFs have low liquidity, so you can say wider bid ask spreads. And because ETFs trade like stocks, some people end up trading too frequently, which can hurt long term outcomes. So, ETFs work best when used as a long term building blocks, not short term trading tools. Before I close, there is a simple checklist to keep in mind before filtering out on an ETF. And these could be: do I understand what this ETF invests in? Is it broad or concentrated? Is the expense ratio reasonable? Is the tracking difference acceptable? Is the ETF liquid enough? And if it's dividend ETF, does it distribute the dividend or reinvest them? All right, a quick recap of what we learned in the entire episode is we covered what ETFs are, how they trade, the main types including dividend ETFs, the key terms that matters, and where it makes sense to start, where to research and buy ETFs, and the real pros and cons. If you want a simple approach, start with one broad index ETF. Stay consistent and expand slowly as your goal becomes clearer. In the next episode, we'll talk about stocks, Keep watching and keep learning. Bye bye.